I think we're coming into a 5-year period that's going to be good for the whole range
Mhm.
of resource and precious metals companies. I remain concerned on the one hand, which is to say for society, but confident for myself that despite the real attractiveness of gold, it's underowned.
Mhm.
Less than 0.5% of total savings and investment assets in the United States are denominated in precious metals or precious metals securities. The 4-decade mean is 2%. If demand for precious metals merely reverts to mean, demand for the stuff grows fourfold. And I believe that the macro environment, which is to say the likelihood that the purchasing power of the US dollar declines by 75% over the next 10 years, the same way it did in the decade of the 70s, means that rather than gold going to 2% market share, it goes to a higher number. That's attractive to me. I'm not suggesting that your listeners should take their portfolios to 50% gold. I am suggesting that any of them that don't have their portfolio at 2% gold are probably taking risks with their family's purchasing power, and they should revisit that. I think, too, and we'll cover this the next time you and I visit, that while the big thinkers in the world think that peak oil demand occurs in 2030, peak oil demand likely occurs in 2065 or 70. When people value companies, they do them on a net present value basis. And if you begin to run down the net present value in year 2025 and you run it out to 2030 and then chop it off after that, you cut the value of the oil company precisely in half. And I think that the oil industry as a whole is selling for half what it's worth. I like buying stuff at 50% off. I particularly like buying stuff at 50% off when they're generating so much cash that they can maintain their basic business while buying back stock and paying me a decent dividend. This suggestion that I have to choose between yield or growth when I could have both is attractive to me. So I hope that helps. And then the last thing that we talked about a bit is the boredom around things like rare earths and critical minerals. The fact that they're out of favor means that there are some fairly small companies that have deposits that are potentially world scale, deposits that will be in the best cost quartile in their commodity category worldwide, in the highest return on capital employed category worldwide, and that have 15 or $20 billion or more in situ value at current commodity prices. And you can buy these companies at fractions of what their net present value will be upon the delivery of a feasibility study. Uh, that conjunction of virtue is almost the textbook definition of how you enjoy 10 baggers or 20 baggers or 30 baggers. And despite the fact that I'm old and fat and bald and rich, and I don't need a 20 bagger, I want some more desperately.
Me too. Me too. Um, so those last 2 points were fantastic. And that's why I'm sniffing around in critical minerals and uranium right now. But on your oil and gas, what you just said, I just had a discussion with the Canadian oil producer just recently. Nobody knows about him here that we're talking about. And it's exactly what you said. They're paying a very healthy dividend, and then I'm participating on the upside.
Right.
Think about that, guys.
Your risk is personified in Carney, the new Prime Minister of Canada, like the old Prime Minister's anti-oil. So we've identified the political risk. You need to decide something about the political future of Canada. If the political future of Canada is even stable, the Canadian oil industry has survived and thrived in 10 years against a prime minister who hated them. Pretty amazing. If the new prime minister is a bit more pragmatic, and particularly if President Trump allows greater U.S. distribution capabilities for Canadian hydrocarbons, I'm not saying it's going to happen. if it does happen, the lid gets blown off this stuff. Absolutely. I'm not saying it's going to happen, but I think
Right.
that people need to look at the upside as well as the downside.